welcome to the Rousseau Report. I'm your host, Dennis Rousseau. Q3 2025 is behind us, and today we're going to provide a quarterly market update because there's a lot happening with our global economic landscape as well as business jet values. Before we begin, congratulations to Gulfstream for the unveiling of the new super midsize G300. It boasts so many improvements over the original G200, as well as the 280. Now let's start out with some positive economic news. I know, coming from me, right? Whirlpool is spending $300 million to update 2 Ohio factories for its next-gen washers and dryers. Yes, there is next-gen, and they're going to be creating 400 jobs. GE Appliance is moving its washing machine production from China to Kentucky. Bravo to them. They're investing $490 million. Stellantis, $13 billion for U.S. auto plants, creating 5,000 jobs. Taiwan Semiconductor building 5 U.S. computer chip factories. The S&P 500 is up more than 20% since April, igniting a bull market. Conversely, consumer credit and automobile loans are in deep trouble. Some are suggesting AI investments and valuations may be exaggerated, perhaps a repeat of the dot-com bubble, although others are saying it's a structural shift with a positive economic outcome. On the employment front, major layoffs continue. Nestle announced 16,000 job cuts. 16,000. Ørsted, the wind farm operator, laid off 2,000. BP, 6,200, and the list goes on. Companies are going to continue to constrain their headcount at least through the end of the year. Manufacturing activity has contracted for the last 3 years, and the economic conversation from Wall Street strategists has been a promised recession. Their words, not mine. The logic was pretty simple. The Fed aggressively hiked rates, inflation spiked to 40-year highs, and the yield curve inverted for the longest stretch on record. Historically, those conditions have been reliable precursors to an economic decline. In 2007, 2/3 of the population didn't see a recession coming. In 2022, 2/3 thought a recession was imminent. Both times they were wrong. Why? Because the economy is complex. It's influenced by human behavior and unforeseen events. Same with current business jet markets, which I'll show you in a minute. Modeling can tell us what should happen, but reality always finds a way to surprise us. Let's take a look at a microdynamic that we've not discussed previously, and that's gross state product, GSP, similar to GDP for the nation, where a sustained decline signals a contraction in overall economic output. It's a foundational measure representing the total value of goods and services produced within each state. According to Moody's Analytics, 22 states and the District of Columbia are now showing clear signs of recession due to ongoing economic weakness and job losses that are likely to continue. Another 13 states are treading water. California and New York represent the 2 largest state economies in the U.S., and they're among the 13 treading water. If they slip further, it could be enough to tip the entire U.S. economy into recession. Another key economic indicator you've heard me mention in prior sessions is the housing market. Key metrics include total sales, inventory, and median prices. Inventory continues to increase, and sales continue to decline. And median prices are on the decline, going from an average $442,000 in Q4 of 2022 to $410,000 as of Q3. A decline in sales and pricing signals reduced consumer confidence and tighter credit. Further housing market activity has a direct impact on construction, building materials, and financial services. To the extent any one sector provides direction, it's the home builders. And bad news, residential investment has been contracting for 5 of the last 6 quarters. Employment and unemployment rates reflect the health of the labor market. A rising unemployment rate indicates a weakening economy. Conversely, job growth suggests expansion. The official U.S. unemployment rate remains at 4.3%, but under the surface, there are deepening signs of struggle for people looking for stable, full-time work when layoffs are on the rise and hiring slowed. Case in point, and something we don't read about or hear about unless we're in that local market. An Alabama-based trucking company filed Chapter 7 last week and immediately ceased operations, leaving 1,000 employees out of work. Now, where do they go? Farm bankruptcies have more than doubled since last year, and all these dynamics influence business jet markets. Of last economic note, with regard to CPI, forecasters expect current quarter headline and core CPI inflation will average 3% annualized, down from their prediction of 3.5%. Now on to business jet markets. Honeywell forecasts business jet deliveries of 8,500 aircraft through 2035, and I believe I reported on this in a past session. But here's clarification. The company contributes this optimism to recent economic growth, increase in demand for fractional ownership, and bonus depreciation. As of the end of Q3, and with 3 months remaining, this is where we currently stand with in-service deliveries, not orders. And to Honeywell's credit, 21 of the 30 latitudes were delivered to fractionals, as were 11 of the 14 longitudes. So yes, there's activity in the fractional markets, but that also takes buyers out of the mainstream or whole aircraft market. Now, will we hit the total 850 deliveries forecast in 3 months? Let's now move to pre-owned markets. 2018 was a healthy year with robust sales. I think we can all agree that the 20% increase in sales for 2020 over 2021 were directly related to the pandemic. Sales then returned to normalcy in 2022 and showed a gradual increase, which based on the numbers through Q3, we should be able to break 1,000 aircraft for this year. Are selling prices reflecting normalcy? Well, from Q1 to Q3, the answer is yes. We are seeing pricing commensurate with value over this 9-month period. Now let's look at the pricing over a 5-year spread, and the data tells a different story. Based on original cost new, then the run-up in 2020 through 2022, then the adjustment in 2025. Bottom line, we still have a way to go for correction. But I believe we're going to see lower pricing in 2026, and to those waiting on the sidelines, next year you should be positioned well to avoid overpaying. As always, there are a couple of exceptions. The 7X and the Global 7500 are reflecting normal year-over-year depreciation. Another data set that supports pricing correction is increased inventory, and regardless of model, quarter over quarter there's an increase in inventory, although days on the market remain on par. In our last market update, we were scrambling to find aircraft models with greater than 10% of the fleet on the market. Today, that story's changed. We're seeing for the first time select models showing the most aircraft on the market since entry into service. The Citation Latitude is a good example. The Falcon 2000 Easy, another one. Although out of production, the Lear 75 continues its ascend. The M2, which generally serves the owner who's also the pilot, is also seeing record availability. And I believe the G280 will break 25 available aircraft before year-end. As I've said in the past, I use aircraft post data throughout my workday, and at the end of the week, they generate market change alerts encompassing data they didn't address during the week. These two show a normal ratio of aircraft added to the market versus those sold, and of course, the number that were withdrawn or those that had a reduction in price. So 20 to 30 aircraft added to the market is normal on a weekly basis. However, when I saw this one, I realized change was in the air. No pun intended. So stay tuned. We'll keep you posted with the information you need to make a well-informed decision. Once again, thanks for tuning in. Look forward to seeing you next time.